Hey there, let's just dive right into this, shall we? Today, we're exploring one of the absolute foundational concepts of the stock market. We hear about the stock market literally every single day, but at its core, the whole system boils down to one incredibly simple question. Why do companies sell shares in the first place? It's a fantastic question, and by the end of this explainer, you are going to have a crystal clear understanding of how it all works. To really wrap our heads around this, I want you to imagine you've got this brilliant business idea. I mean, it's guaranteed to be a massive hit. But there's a catch. You need $10 million to actually turn that idea into reality. Now, you could go and try to borrow all that money from a bank, but what if there was another way? What if you could raise millions of dollars without taking on a huge, crushing loan? Well, this exact scenario is the main reason companies choose to sell shares. To see how this plays out in the real world, let's put a face to the concept. Meet our fictional founder, Sarah. Sarah starts a company called ABC Tech. Her business is growing fast, which is amazing, but she's hit a bit of a wall. She needs $1 million to build a brand new factory, hire some more employees, and expand her product line. Instead of going to the bank and borrowing that entire $1 million, she decides to do something a little different. She decides to sell a portion of her company to investors. So that brings us to our first crucial question. What exactly is a share? Think of Sarah's company, ABC Tech, kind of like a giant pie. She can divide the ownership of her company into many small slices. We call these slices shares. If Sarah cuts her company up into 100 total shares, and you, as an investor, decide to buy 10 of those shares, well, that brilliantly means you now own exactly 10% of the entire company. Investors buy these shares, handing their money over to the company, and in exchange, they receive a concrete percentage of ownership. So how does this cash flow actually work? It's a pretty straightforward life cycle. Step 1, you start with an idea. Step 2, the business starts growing and you need capital, which is just a fancy word for money, to expand. Step 3, you sell shares, those slices of the pie, to investors. And finally, step 4, that cash flows directly into the company to fund business expansion. We're talking building factories, hiring workers, developing new products. It is quite literally a direct pipeline from investor pockets straight to company growth.
Now, eventually, every single founder looking to raise capital arrives at a crossroads: loans versus shares.
Let's break down how these two paths differ, because it's absolutely crucial. On one side, we have a bank loan, which is known as debt financing. With a loan, the company strictly has to repay the money they borrowed plus interest. It's a guaranteed, unavoidable future expense. On the other side, we have selling shares, or equity financing. When a company raises money this way, there is no required repayment. You don't have to pay the investors back on a monthly schedule. However, the trade-off is that the existing owners get a smaller percentage of the company. Their personal slice of the pie shrinks. This quote from our sources really hits the nail on the head. It says, debt financing, in simple terms, is using other people's money. In exchange, you pay them interest. That interest is the literal cost of borrowing capital. And for a young, fast-growing company, those fixed interest payments can be a really heavy burden on their cash flow. Plus, taking on corporate debt can get insanely complicated mathematically. You have to calculate financial leverage, operating income, earnings before interest and taxes. I mean, it gets incredibly dense, incredibly fast. This complexity, combined with the strict repayment schedules, is another massive reason why founders might prefer the much simpler route of just selling shares.
Okay, so we know how it works mechanically. Let's look at this purely from the company's perspective.
Why actively choose to sell off pieces of the business you built? Well, the pros are pretty huge. First and foremost, no loan repayments. This means the company preserves its precious cash to fuel actual growth rather than just servicing debt every month. Second, it means shared financial risk. If the company fails, the founders don't have a massive bank loan hanging over their heads. And finally, investors aren't just walking wallets. They often bring highly valuable industry expertise and vital connections that can really help the business succeed. But, it's not all sunshine and rainbows. There are definite downsides. The biggest one is dilution of ownership. Like we mentioned earlier, when you issue new shares, the founder's slice of the pie gets permanently smaller, which can lead to a real loss of control over the business. Plus, if the company becomes wildly successful, you now have to share all those future profits with your new shareholders. And let's not forget, new investors mean new voices in the room, which can sometimes lead to messy conflicts over the company's strategy. Let's flip the script for a second and look at the investor's perspective. We've talked about why the company does it, but why would an everyday investor actually want to buy these shares? Basically, investors buy in because they want to become partial owners of a business they truly believe in. They are essentially betting on the company's future. If the company performs well and grows, the market value of those shares will likely go up, leading to capital gains for the investor. On top of that, some established companies actually share a portion of their profits directly with shareholders in the form of regular cash payments, which we call dividends. Now, I have to point out the very real risk here. The stock market is definitely not a guaranteed win. If the company struggles or if the overall market just declines, share prices can fall. This means investors can absolutely lose the money they put in. There are zero safety nets when you buy equity. You are taking on that risk for sure. So we've looked at Sarah and her $1 million startup. But what happens when we scale this whole concept up? That leads us to going public, or the IPO. IPO stands for Initial Public Offering. In plain English, an IPO is simply when a private company offers its shares to the general public for the very first time. It is that exact moment a company transitions from being privately owned by just a few founders and early investors to being a publicly traded company on a major stock exchange. And let me tell you, this is a massive part of our economy. Just to put it into perspective, during the market boom back in 2021, an incredible 1,035 companies went public in the United States alone. That is over 1,000 companies opening their doors to public investment in a single year, all just to raise capital for their next big stages of growth. But going public is definitely not cheap. It's a highly expensive and incredibly regulated process. Believe it or not, up to 10% of the total money raised during an IPO can go straight to paying for the legal, accounting, and investment banking fees required just to set the whole thing up. So if a company raises $100 million, they might literally be handing over $10 million of that just in fees. All right, we have covered a lot of ground today. Now it is your turn to choose. I have a challenge for you. Imagine you are the founder. You currently own 100% of a fantastic company, but you desperately need $1 million to expand. You have two choices: take out a bank loan and keep all your ownership, or sell 20% of your company to investors to get the cash risk-free. Which option would you choose, and most importantly, why? I want you to defend your reasoning down in the comments below. Seriously, let's get a debate going. Before we wrap up, let's do a rapid-fire recap of the whole shebang. Why do companies sell shares? Primarily to raise capital. What do investors get? They get partial ownership of the business. Where does the money go? Well, those funds fuel the company's expansion. What's the cost to the founder? Their ownership percentage dilutes. And finally, what's the catch for the investor? They take on the financial risk if the company doesn't succeed. And there you have it, the fundamental mechanics of exactly why companies sell shares. If this explainer finally helped you understand this crucial piece of the financial puzzle, please hit that like button and subscribe for more simple, structured market lessons. Don't forget to answer today's question in the comments, and hey, let me know, what complex topic should we explain next? Thanks so much for learning with me today, and I'll see you in the next one.